Joining me now is Greg Ip. He's the chief economics commentator at the Wall Street Journal. You were early, Greg, to note that the safe landing odds here aren't great. What would you say ahead of this meeting, though, to a pretty concerned investor base?
I don't think I have much that's very comforting, Kelly, as you and I have been talking about over the months. I mean, the Fed's got a real problem. Past soft landings occurred when all they were trying to do was prevent inflation from going up. Now inflation is already too high, and they're trying to push it back down. And I think that's one of the reasons why they're in this rush to start runoff on the balance sheet. As you were mentioning a minute ago, the last time they did this, which began in 2017, because inflation was already so low, they really weren't in any hurry. And they proceeded very gradually. They maxed out at $50 billion a month of runoff. They wanted this to be as boring as watching paint dry. But inflation today is like 8% or higher, depending on the way you measure it. They want to get that rate down, and they basically waited too long to start this process of tightening financial conditions. So I think that's one of the reasons why they need to get the process started soon, why they're going to ramp up quickly, and they're going to do it much faster. And I think that, unfortunately, for investors, they're going to be much less swayed by the pain in the markets, such as what we're seeing today. It's going to make much less difference to them in terms of how fast they go.
If anything, it helps achieve their goal, because the goal is more or less a tightening of financial conditions and kind of breaking the economy. What about the supply chain piece, Greg? Because a lot of what you're talking about into the future is predicated more on wage gains and services inflation. But we shouldn't discount the fact that supply chain problems can still contribute and be sticky, right?
Well, this is the real problem for the Fed, right? I mean, let's go back to Econ 101. Inflation occurs when demand exceeds supply. What central banks do is they move interest rates around in order to modulate demand. They can't do anything about supply. We've always known that. And here we have a situation where, yes, we have strong demand, but we keep getting hit by one supply shock after another. First, it was like COVID. Then it was the Russian invasion of Ukraine. And now we have layered on top of that all sorts of protectionist actions and other things going on. Last week, Russia cut off gas supplies to Eastern Europe. Indonesia banned exports of palm oil. The thing I worry about, Kelly, is that we're facing many years of an environment in which that keeps throwing up supply shocks like this. A little bit of a history lesson. People often forget that the 1970s wasn't just a period when we had strong demand and wage price spirals. We also had one supply shock after another, not just energy, but also food. That just makes life really hard for central banks.
You're right, because if the fundamental problem is too much demand, it creates shortages everywhere. The other thing I wonder about, Greg, is, if the Fed doesn't fix this, politicians are going to try to. And we've already seen some pretty interesting proposals aimed at, containing inflation. And the longer this becomes entrenched, the more political firepower the fiscal policymakers are going to have to try to bring this down their way and possibly create an economy that's even less dynamic and more inflationary in the medium term.
Right. I know it's definitely not encouraging when the best solution that policymakers, that Congress can come up with to this inflation problem is to cut the gasoline tax, whether at the federal or the state level. I mean, what does that do?
It increases demand
for gasoline, right? So that is not helping. However, let's step back also and look at the cyclical picture, though, for a moment, though, because one of the things we're seeing going on in the markets is that I think that we have three hits to economic growth happening all at the same time. The first is the supply shock effects you and I have just been talking about, like higher energy prices, higher food prices. That's like a tax increase. Second of all, there's no more fiscal stimulus. In fact, when you look at the numbers, the degree of fiscal tightening this year is almost a record. And third, the Fed is working away at the background on both the short-term interest rate and long-term rates. Long-term rates are up more in 6 months, in the last 6 months, than they have been in any 6-month period back to 1994. So that's a triple-barreled dose of economic headwinds that the market and the economy are going to have to deal with. So I think that, painful as it may be, these forces will start to actually have the usual predictable effect on both demand and inflation.
Well, in which case, maybe we can get back to normal after a very tough period of sailing ahead of us. Greg, we'll leave it there for now. We thank you so much.
Shepard Smith here. Thanks for watching CNBC on YouTube.